Like think about it, Mackenzie. Today, for many that are building their portfolio, have a mortgage, they may be 50, 60% higher than they were 2 years ago, right?
Yeah.
So when they got into that property, maybe it was cash flow positive, maybe they were breaking even, they were happy because they were gaining equity. But today, most of these properties are not cash flowing. So understanding tips and tricks on when you're looking for a property, how you can give yourself the best option to actually cash flow or at least break even versus having to be negative equity every single month. And that's where our expertise can really guide people in the right direction.
So I've got Gary here with 812 Mortgage. They're our newest partnership we brought into the single key community and our marketplace. And this is a great conversation to get into around how to structure your mortgages, especially for the landlords and the homeowners out there looking to expand their portfolio. There's a really key strategy in place to qualify as much as possible without hitting that lending wall that we all know about. And Gary's our expert in that. And we'll just go back and forth, have that conversation and learn something new. So Gary, thanks for joining me today.
Yeah, awesome. Thanks for having me on the podcast, Mackenzie. I'm excited.
Yeah. So maybe a quick introduction for the people that don't know you, a little bit of your experience and how you came to be at 812.
Yeah, for sure. So my name is Gary Fooks. I'm the CEO and co-founder of 812 Mortgage. We are a national brokerage. We work with pretty much every lender across the country. Taking a step back, my background is I spent 20 plus years scaling, sales and marketing campaigns for companies globally. And I was able to do that with the use of technology. So I've been, building technology and implementing it into scaling growth opportunities for, over 20 years. And, I kind of took my passions for sales and service and applied it to the mortgage industry. I first came into the industry end of 2014, saw a lot of room for disruption and, jumped in head first. I was always a big believer. If I'm going to, open a bakery, I need to know how to make the bread.
Yeah.
So got licensed, started, building a very big portfolio very quickly. By my third year, I was processing just shy of $100 million a year. And, just wanted to keep growing the business and providing great opportunities for, clients and other, mortgage professionals within the country.
Amazing. Love it. I'm going to dive into perhaps how you've disrupted the industry. I'm actually really curious about that. What we want to cover today for our listeners is the homeowners out there, perhaps the young investor or older investor that's still in that growth phase and acquisition phase. What are some strategies that we can do so they can maximize their lending abilities before hitting that global limit that the banks have where they say, no more, I don't want to lend to you. Another mortgage, you're too risky. What would be the right approach if we'll attack it from someone has not got too many mortgages or they have no mortgages in their name today, or perhaps just their primary residence. What should they do there? And then perhaps we have some conversations around if someone's already perhaps has a number of mortgages.
Sure. So for kind of the newcomer to the industry, I think it's important that you get the right advice. The mortgage industry, unfortunately, is still very fragmented. You have different stakeholders. There's banks, there's smaller lenders, credit unions, trust companies, and there's mortgage brokers. And unfortunately, not all mortgage brokers are made the same or have the same type of access. So it's really important that you dedicate yourself. You find someone who's experienced, who's done a lot of volume, obviously understands the industry inside and out, and you kind of, hang your hat on them, right? One of the mistakes that people make, and it's very common, is they try to shop around. And unfortunately, in mortgages, when you shop and lenders kind of see the same profile, from multiple different sources, it actually hurts you. It doesn't help you. So it's, find the right person, make sure they're experienced and really follow their advice, because mortgages is much more complicated today than ever before.
Yeah, absolutely. Especially with the stress test that's been brought out. It's been out for a while now, but still relatively new in the long game. And Gary, you brought up a really interesting point I want to highlight. I think that's a great pro tip. And for someone that doesn't understand the industry a lot, you're saying that shopping around, if someone's perhaps getting hit with multiple credit checks, is that kind of where you're going with that? What's that differential hit there?
Sure. So that's a big one where, people tend to want to get the best deal. And obviously that's great. And what they'll do is they'll go from bank to bank to bank. And obviously every single bank will hit your credit to see that if you qualify. Now, the advantage again of working with a mortgage broker is that we can pull your credit one time and we can take that credit score and really shop it to hundreds of different lenders, regardless of, the fact that, we're going to each single lender. So that's an advantage to you as well. What I was really getting at though is, especially for landlords and people that have more than one property and as their personal financial situation is a little bit out of the box.
Yeah.
We have to put the right story together for lenders so that it makes sense.
Yeah.
And you can imagine if you get two different stories, if they vary a little bit, lenders are not going to side with one or the other. They're just going to say, look, two different stories, two different brokers, two different applications. we'd rather just pass on the client altogether.
Wow. Yeah.
And that is what's happening in the industry because they don't want to play favorites as well. So
Yeah, that makes a lot of sense. Just from my experience, I've had these conversations. Like you said, a good mortgage broker, and correct me if I'm wrong, you guys will grab all the information up front, and every lender has different paperwork requirements, income qualification, if you're talking about rent revenues, all these different things. And you guys will pick and choose the best picture to put in, or offering to put in front of that lender, which I think is again why it's critical to work with someone like yourself that knows this vast market of the different lending requirements.
Yeah, absolutely. And more so today than ever before, Mackenzie, because lenders have tightened their guidelines, especially when it comes to rental policies. And that's where, having someone that knows how to unlock that buying power becomes a massive competitive advantage for that specific person that is trying to, advance their real estate portfolio.
Yeah. Do you got some tips around if someone's just starting out and they're coming to you for the first time, Gary, and like, okay, here's my game plan. Is there a conversation to be had of what their end goal is, or if they're kind of talking about, if I want to be in a position to act and move quickly, what do I need to do first with you, Gary, to have success?
Yeah, look, I think it's important that if I'm going to provide you with advice, I need to know what your end goal is. Like, what are your goals? What are your objectives? Not just maybe for the first property, but do you have objectives to have a second, a third, a fourth? And then we want to align those goals, not just from the portfolio size, but also from a, debt servicing perspective, a cash flow perspective. Like, think about it, Mackenzie, today, for people that are renting, their mortgage payments, for many that are building their portfolio, have a mortgage, they may be 50, 60% higher than they were 2 years ago, right?
Yeah.
So when they got into that property, maybe it was cash flow positive, maybe they were breaking even, they were happy because they were gaining equity. But today, most of these properties are not cash flowing, right? So understanding tips and tricks on when you're looking for a property, how you can give yourself the best option to actually cash flow or at least break even versus having to be negative equity every single month. And that's where our expertise can really guide people in the right direction.
Yeah, I love that. And is it important on who you might pick for a lender first? If someone's got a growth target, say like get the 10 or 12 properties, that's like their end goal, and they have a relatively clean slate for you to work with, you probably have a very targeted way in how you'd approach that. Do you want to get some insight to that?
Yeah, for sure. So the biggest misconception when I do speak to landlords or potential landlords, the biggest misconception is that, and you talked about this earlier, is that they look at the fact that they may have many properties and that's a huge asset. But in the financing world, the lenders, the banks look at that as a liability, right? Because you're over leveraged, you're overstretched. What if things go south? So, and then a lot of lenders have limitations on portfolio size, right? You may have one bank that says, look, we cap out at 2 to 4 properties. Whereas there could be some more alternative lenders, some credit unions that allow you to go up to 10. Well, let's max out the lender that allows the 2 to 4 and then have the other one as a backup instead of doing it in reverse, because then you're hamstringing yourself from being able to have more than one option. So this is where, again, understanding those policies and guidelines, and there's over 7,000 products in the mortgage world across the country. So you can imagine if you don't have expertise, if you're not using a lot of the technology, which is one of the questions you asked about disruption, you could be preventing yourself from achieving your goals, and that's where, again, having the right people involved is very crucial.
That's so true. And I think that's such a pro tip, Gary, is for me to be successful in this real estate game as an investor, to hit my growth targets and my portfolio size, I've got to have a stellar team around me, from the mortgage broker to the lawyer to the real estate agent, to all those folks that help me get there. And perhaps going with someone, like you said, there's no equal mortgage broker. There's many sets of skills and experiences, and the smart ones that understand your goals and where you want to be. That could be the difference to getting 10 mortgages to only getting 4 if they don't pick the right lenders at the front. Which I'm going to ask you a kind of a common misconception here, Gary, is I think if I get the lowest interest rate, that's the most important. But if you came back and told me, like, well, if you want to get the 10 properties, perhaps there's different products that might have higher rates, but then globally you're at where you want to be.
Yeah, you nailed it. That's exactly the case. And that's exactly what happens. I speak to clients all the time, and that's really what they're focused on. It's all about the rate, but the rate doesn't mean the best product and doesn't open them up for growth, right? And if you're really building, your generational wealth through real estate, you really have to look at not just the cost of capital, but how you can leverage that capital. And that's, a lot of times paying 0.5% or 1% higher on a mortgage, but allows you to expand your portfolio by 3 or 4 properties is a lot more advantageous than just having one property that's, 1% cheaper on the mortgage rate.
I love that. And that's so true. So if we kind of pivot up the chain to someone that might be a little bit more established, maybe they already have 2 or 3 rental properties or somewhere in that size, what are some things they could do today or implement into the business to ensure they're very effective at looking great on paper? And we can speak to that from, say, managing their revenues coming in from the rent side. And perhaps this probably leads a conversation to one of the key factors you guys look at, which is something called a DCR. Yep. Do you want to maybe dive into what that means and why that's important?
Yeah. So debt coverage ratio. So again, when you're applying for a mortgage, whether you're buying a property to live in it, whether you're buying, your first real estate investment property, your second, your third, your fourth, what lenders are looking at is your entire profile, right? That's very important to understand. Your entire profile means obviously your credit score, right? Your income, your assets, and your liabilities, right? Mm-hmm. So if you think about that, you want to limit having a lot of, from a liability side, you want to limit your monthly expenses, right? Having, a beautiful car is amazing, but if it's costing you, $2,000 a month in today's world, that's the equivalent of about $300,000 or $400,000 worth of mortgage buying power.
Wow.
So you really want to limit your liabilities, your monthly expenses, your credit card payments, your loans, your leases, your lines of credit. And you want to have, verifiable income if you can, right? And then obviously have other streams of income that can help you, increase your mortgage buying power. Rental is a big one as well. And that's where a lot of times, people make mistakes where, they're not declaring their rental income. They're buying properties, not realizing that they can't use some of the basement income or other room income because, lenders will not look at it as verifiable. Mm-hmm. So again, income, liabilities, rent rolls, these are all things that are very important. And that's how lenders look at, debt coverage ratios, right? They take all the parameters of, what are your monthly expenses, in your whole profile, and they layer in, vacancy rates and heating costs and condo fees, to come up with a formula that will then help you understand how much you can qualify for.
Oh, love it. And let's kind of continue on that conversation, Gary. If I came to you and say, hey, I'm looking at this property, what would you recommend to me if I'm looking at, should I pick a 25-year amortization, a 30, maybe 35, if that's still available, depending on what products are out there? What would be your recommendation to an investor on some of these common variables and how to structure them?
Yeah, look, I think given rates being somewhat equal, right? A little bit of play.
Yeah.
I would always advise that a client would take a longer amortization, typically a 30-year in today's market.
Love it.
And then, if they want to increase their payments by 20% to, then have the same type of payment plan as a 25-year, then they can do that. Because once you start with the 25, you can't go backwards. And when you're a landlord, sure, there's amazing products like single key offers with, rent guarantees, et cetera. But if there's certain landlords that don't have guaranteed rental income, then you want to make sure you have that flexibility so that if the tenant is behind on, rent, et cetera, then you have that play to kind of make sure your mortgage payment can be reduced to offset that cost. But once you squeeze yourself into a really tight product, there's no more play available. And you could be upside down, which could negatively impact your portfolio.
That is such a great pro tip, Gary. I mean, and that was one of the first things when I got in this business, I learned as well is that age-old term, cash flow is king. And you can still get the same benefits of a shorter amortization by leveraging and lump sums, prepayment, monthly top-ups, all these other kind of what they call payment features, or I'm not sure the right word for it, but leverage that to get that, at the end of the day, you want to pay less interest and keep your costs down. But having that flexibility to have a better spread on your cash flow, especially if rents dip again. I know you guys have been strong out east in Ontario, but in Alberta, mid-2010s, like 2014, 15, 16, we got kicked really bad coming out of our peak. And we had rents drop across this province. In the big cities, Calgary and Edmonton, they dropped like 21, 22%. But in the more smaller markets where there's single or only dual service industries, like the oil patch and stuff or agriculture, they dropped as much as like 35%. Like a third of their rent was gone over a 2-year period. And if you've stretched yourself to get the shortest possible mortgage to pay off as quick as possible, you've got no flexibility to manage that. And it's still a business at the end of the day.
Yeah. And I think, one of the reasons that a lot of people have that mindset where it's shortest amortization, smallest rate, pay off your mortgage as quickly as possible is because, a lot of landlords are, for the most part that I've experienced, they've been around for a while. And they're coming from an interest rate environment that was much higher.
Yeah,
20
good
years
point.
ago, rates
Yeah.
were 18%.
Yeah.
So yeah, you should pay off your mortgage as quickly as you can,
Yeah.
right? But over the past, 5, 7, 10 years where rates are in the 2s and 3s, it doesn't make sense because the cost of that money is so inexpensive, right?
Yeah.
It's different today. And I think today is where a lot of renters are now, thinking about, how do I get through this? Because I think it's inevitable rates will come down at some point. I don't think they're going to be drastic, but if they can get through this next, 12 to 18 months, and having that flexibility with, a longer amortization schedule and a lower monthly payment, they can recoup that with the appreciation of the value of the property over time as well. And that should offset, the longer payment cycle.
So well said. But yeah, like it seems counterintuitive on the surface to like, oh, let's pay off this mortgage as much as possible. It is the largest cost center to running a property. But oh, yeah. And if we're talking about investment properties versus your primary residence, I'm sure you have this conversation all the time, talking about how you can write off the interest to a rental property because it's an investment. So
correct.
Where you can't do that on the personal side too. A question too I get is getting access to money, Gary, which is where you guys are really great at unlocking equity. What would be some tips around if I want to set myself up today where get as much access to equity down the road where I know my plan in the next 2 to 3 years or 5 years maybe is to do that next purchase? What would you be giving me? What would your thoughts be around how you'd help me structure myself today?
Yeah. So again, it's understanding your entire profile, right? It's, what do you own? What are your mortgage payments? What's your income? What's the nature of your income? A lot of times, especially for clients that have untraditional sources of income. When I say untraditional means, they're not just a job letter and a T4 pay stub, but maybe they're self-employed, maybe they're gig economy, maybe they're cash earners. We have a lot of products where we can leverage that income to give you quite more buying power than you can imagine and much more than you would get at a bank, right?
Amazing.
Sometimes we can, give you 5-to-1 buying power from what the bank would offer you from a mortgage perspective.
Wow.
And that just changes the game exponentially. And what happens is people are so focused on the traditional sources of income, not knowing that they have these other opportunities available. So the best way I can describe, Mackenzie, is if you go to the doctor, right? The doctor needs to understand all your symptoms, right? And if they don't understand all your symptoms, it's really hard to give you the right diagnosis and more importantly, the right prescription.
Yeah.
And that's really the way we look at mortgages, right? I consider myself and my team as doctors, and unfortunately, we're analyzing your financial health and not your personal health. But understanding that whole profile is where we can really make sure we pinpoint the problem and provide you with the best possible solution to solve that problem.
Amazing. That's so cool. Yeah. Well, so we did talk about in the beginning of the show, Mel, this would be a good time to pivot back to, you mentioned disrupting when you first got in the industry in 2014. So tell me, what did you see as an opportunity and what did you do differently than, say, to your competitors?
Yeah. So for me, technology was the big one. So my two passions are sales and service. And what I loved about mortgages and the mortgage industry is that, for me, sales is convincing someone that I'm providing them with the best advice, and then service is delivering on the promises that I've made. And, what I really focused on was understanding the industry, understanding the ins and outs. And I really gravitated right from the beginning to more solution-based lending. And that's where I started, having the opportunity to work with landlords, because these were people that were constantly being told, you can't get more. There's no more available. Like you're done. And meanwhile, they're coming to me and we're opening up opportunities for additional properties, larger mortgage amounts, et cetera. So that was, number one. And then number two is using technology to streamline the business and make it more effective and efficient, right? Because when you use technology and you can, especially in today's world, we're talking about AI and machine learning. Yeah. That's really the big difference for us is we use a lot of data and machine learning so that when we're putting client profiles together, the machine can now tell you, hey, here's the list of lenders that would theoretically fit this profile. Because no matter how good we are to memorize 7,000 products across the country is impossible.
Oh, interesting.
So really just using a lot more digitization, machine learning to figure out the best solution for that client. Yeah. Because suitability for us is extremely important. We want to make sure we're putting clients in the right product, the right price, and not defaulting to maybe some favorable lender relationships or some higher priced products because it's easier to do.
Just
and
to
that's
execute.
Really where I'm seeing the majority of disruption, at least for us today.
Oh, that's super interesting. So and I didn't even think of this. So you guys are leveraging some of the the large language models or commonly known as AI to make sure you're getting as many possible options on the table for that particular client and that unique to their situation.
Yeah. So
Super
more of the
cool.
machine learning to start, where again, having all the criteria, right down to the square footage of that property, and really being able to unlock maybe some off the beat path lenders that would, do that deal where mainstream lenders would maybe not look at that property. And that could be the difference with a client paying, $2,000 a month for the mortgage versus paying $4,000.
Wow. That's super cool. I didn't even think of using AI that way, but it would totally make sense because it is just so complex. And I've been fortunate enough to work with, very experienced individuals like yourself, where you're playing that chess match game of finding the right product. If my end goal is X number of properties to get me there, which is super cool. So common questions I hear often in the landlording space is, what are some things or tips I can do to look great on paper? So if I'm managing my rent coming in and perhaps I'm doing jobs with the tenants, is there a right way to structure that rent coming in so it looks the best on paper? Got any tips around there?
Yeah, for sure. So obviously one of the things you always want to do is, try to have the largest rent roll that you can do. If you have to credit back the tenant for some items that they're working on, it's better to do that by way of a credit, because lenders are going to look at your actual rent roll, what you're declaring, what the lease says. If, for example, if your tenant is saying, hey, I'll pay $100 a month less if I can, cut your grass or shovel the driveway, that's great, but offer it by way of a credit. Don't reduce it from the rental amount, because the smaller the rental amount, the less buying power that you have.
Oh, Gary, that's such a pro tip. So I want to highlight what you said because that's just so important. So, if someone's listening, keep those rents as high as possible. They look stronger on paper. And if you have to do any credits for cleaning, move out, whatever it might be, jobs on the side, do that through a separate e-transfer, something else. Don't just deduct and lower your rent, because now you look smaller and less buying power on paper. That's such a pro tip.
Yeah. The other thing that's important is, a lot of landlords may not be declaring their full rental income. That's another big one, right? If you want to use it, you have to declare it. If you are, not charging the same amount every month, that becomes a red flag, because lenders won't understand why one month, the rent was $2,800 and the next month it was $2,900. And this is where, sending the credit back versus adjusting the rental amounts will protect you from what could look like unstable rental income.
That's a good pro tip. I never even thought of that. So keeping, in theory, it should
consistency.
Consistently, like a stable revenue source on an annual basis, because obviously they all understand if rents change or renewals come up. But that would make sense if they don't understand why there's such fluctuation. It looks volatile, which then they might discount the qualification, only use half of your rent. All of a sudden now you're looking far less favorable in paper than what you should have been.
Or just not use it at all. Maybe not believe that is your actual rental income, right? So if you think about Mackenzie, if you're not declaring the rental income, and then you have these random payments coming in at random times of the month and random amounts, and they look somewhat similar and they're coming in around the same time of the month, it's really hard to say that is your rental income, because the lease is not going to match, the variability, right?
A huge debate I've seen in my Facebook group as well is this whole thing around utilities. It's such a pain in the butt, because obviously, and speaking from Alberta side, if we flat rate our utilities and just budget for it and build it into our rent, well, then there's no incentive for the tenant to keep the lights off and turn down the heat and all those kind of things. But from your perspective, that looks great, because now you've got a stronger, higher rent and it's consistent on paper. Versus, I know some landlords will go and will pull out the rent and just manage it completely separate from the picture. And so it's really important what your goals are, and I think getting clear on that,
and more of understanding what the requirements are. Because then you can build your goals to match the requirements and not the other way around. It's a lot harder to go back and explain a story than it is to set up the story properly right from the beginning.
Cool. So another question I get often asked is, hey, I'm looking to expand. I've got my 2 or 3 properties. I've got a bunch of equity built up. How do I get access to it? And maybe if they're looking to buy a property today, and I've heard conversations around readvanceable HELOCs. What is a readvanceable HELOC, and how could that help perhaps a investor not have to perhaps go through a refinancing? A finance or an I'll let you explain, because you'll do it much better.
For sure. So this is like a whole other topic that we could probably do a whole other podcast on, right?
Yes.
So first of all, just to clarify for maybe some less savvy real estate investors, a HELOC stands for a home equity line of credit. So it is a line of credit that is secured buy your home, right? That's the asset. Theoretically, it's still a mortgage. The only difference that when you have a mortgage, you pay a fixed monthly payment for the most part, and a portion's principal and a portion's interest.
Yeah.
With a HELOC, you have the flexibility of just making the interest payment. So you don't actually have to pay it down, just to clarify what that means. So a readvanceable HELOC would mean that, you have, let's say you're qualified for a $400,000 HELOC, home equity line of credit. If you've only taken 100,000, you're paying interest on the 100,000. You may be then paying down part of that principal. You get it down to 50. Well, you can use up to 400,000 at any time, right? So that's your global limit, and that's what you can tap into. So that's really helpful for people because you're only paying interest on the money that's being used.
Yes.
If you don't take the money out, you don't have to pay interest on it, versus an actual mortgage. Even if you're not using the money, you have a mortgage, you have to make the payments.
Yeah. Right? And you're kind of, when we're talking off air, you're explaining this to me, Gary, talking about if I go that readvanceable route, as that equity becomes free in the property from paying down the principal, you'll get access to that later on. And then that avoids me, say, if I didn't structure it right, I might have to go and do another mortgage qualification. And what does that mean? The layman thing, and this is what you're trying to do, is get people qualified for properties. If I can avoid one of those events, what does that mean?
Look, you always want to avoid having to do new mortgage applications, right? Yes. Rules change, debt servicing change, your income changes, what you declare. Like, if you've really spent, a lot of times when you have fluctuating income, for example, lenders will require a 2-year average, from the same income source. So if there's a change in your job or a change in something, or you were off for a bit, that might negate the last year and a half, almost 2 years of you've been working to qualify for something.
Yeah.
So where you can tap into the equity and have it available, it's always highly recommended. Another big mistake that people make is, again, going back to trying to pay down your mortgage or putting lump sum payments into the properties. It is much harder to get that money out in cash, right? To refinance and do a big, what we call equity takeout.
Yeah.
In today's world, more than ever, lenders are really scared about, fraud and anti-money laundering. So the idea that someone comes and says, look, I have all this equity, I have $1 million of equity in my home and I want to pull out 500,000 because I'm thinking of buying a property. Well, they're going to say, you know what, go buy the property and then we'll give you the 500,000. They're going to want to direct the funds for fraud, insurance reasons, et cetera. So again, these are things that we have to talk about as people are, planning their future and their portfolio and their purchasing. Want to make sure we set them up for success.
Amazing. That's super cool. Yeah, it's kind of what you talked to me there is, if the readvanceable makes sense depending on what you're trying to do, you don't have to go through another mortgage qualification, protect your score, less credit hits. And, and then like you said, you don't know tomorrow that you could qualify for today. Tomorrow might be a completely different story. So thinking forward and knowing those goals, you guys are really good at architecting a financial masterpiece solution to get your clients there, which is highlights the importance of working someone with an expert like yourself.
Yeah, and we're even seeing that today. Like we're hearing talks of the government, the regulators, lowering the income to mortgage amount ratio and things like that because they want to obviously get a better handle of the market. So, and especially on the investment side, right? Because we have a lack of housing in Canada.
Yeah.
And the goal of the government is to try to, limit that housing for people that are going to buy to live in it. So that, they're really, making it more difficult for investors to expand that portfolio as a result.
Yeah. Cool. Is there is anything I haven't asked yet, Gary, that you think is worth addressing to help out the listeners when they're
I would say with respect to like property types and obviously like single family homes or detached homes where there could be more than one source of rental income. So property types is a big one today. Like we're seeing, condo rental incomes coming down quite a bit, especially in the GTA because there's a lot of condos available, but there's not a lot of houses available. Yeah. So that's property types is one. And then those properties where there could potentially be multiple sources of rent. Very important to understand what requirements are needed in order to be able to utilize those multiple sources of rent.
Amazing. Yeah. So really, if someone is going to start or they're at this step in the journey, sounding like to me the first step is sit down, have a discussion with you, get clear in your picture, those goals, and then all those different variables we just talked about, you're going to architect a game plan to help your client get there.
Yep.
Amazing.
Yep. Taking into account cash flow, income, what happens if you don't get rent payments for 6 months, do you have an emergency fund? What does that look like? So there's a big discussion there to make sure we set them up for success.
Is there anything else I can hit you up on that we haven't covered yet?
What I was going to tell you regarding the multiple sources of rental income. So for example, in a house, like a detached house, a lot of people like to rent their basements, right? And although they may be renting the basement and collecting a rent, they may not be able to use that rent for the purposes of helping with their mortgage qualification, right?
Okay.
So where there's no self-contained unit, there's no, separate entrance, kitchen, bathroom, lenders will actually not allow them to use that rental income.
Oh.
Right. So we want to make sure that not only when they're buying a property, the property's set up where you can utilize that source of income for the purposes of qualifying for a mortgage.
That's really interesting. Okay, so I'm going to show you where I'm at right now. So I've got a handful of properties here in Calgary. They're all that simple single-family house with a legal basement suite, but they are fully contained, meaning they've got their own self-contained. They've got their own kitchen, all that good stuff, access to the furnace or whatever your local bylaw building requirements are. But from a lender's perspective, how you guys define with whether or not that income or rent revenue will qualify towards the next mortgage is if that unit is fully self-contained. I didn't know that. That's a really nice
so it's a legal basement, or is it self-contained? Separate entrance, kitchen, bathroom. These are things that lenders will want to see and know, and they'll see it on the appraisal. Because if it's not, if you're sharing an entrance, if they're using the kitchen upstairs, I mean, they're not going to use that rental income for that basement.
Yeah, or it's like a room with a hot plate. So
yeah.
Oh, exactly. Good pro tip there, Gary. I really appreciate that, because that's critical. And you know what? I got challenged, and I had an old school realtor, phenomenal guy, but he was like, "Oh, why would you want to spend the money to legalize your suite? Like, you're going to collect the rent anyway. Save that 15 or 20 grand and reinvest it." And I was like, "Well, in Calgary, I don't know where you guys are up here, because where are you based, Gary? Is it Toronto?
I'm in Toronto. Yeah.
Okay. Yeah. So in Calgary, like, long story short, they put through a blanket wide secondary suites rezoning that we can do it now, which is great. We're a little behind the times, but I expect once they're done this grace period, they're going to probably do some sort of enforcement. And I'm not going to lie, it's pretty easy to find a property if you just go onto whatever rental website, then they'll ask the questions and you could get shut down. And then from a risk perspective, I didn't want that, where I needed that additional $1,500 off my now I'm negative cash flow, and all the worries that come along with that. But that's a great tip around qualifying for your mortgage qualification, having those things and what the lenders look at to maximize the rent revenues that you're bringing in.
Yeah, absolutely.
Very cool. All right. I'm going to ask you the golden question. We're looking in the future. We're going to talk about some interest rates. What's your take on the market? Where you think we're going? Anything to be concerned of, or what your thoughts are?
Yeah. So whenever I get that call, and I get it multiple times a day, or where rates are going, I always get stuck because I always leave my crystal ball in different places in the office. I have to go get it and kind of figure it out. But if I was to take a guess, I'd say it's inevitable the rates are coming down. Again, barring some unforeseen world change.
Large economic event. Yeah.
Yeah. Right. I mean, if COVID, 2.0 hits, that may change. But I do expect rates to come down. I'm very confident that it will not be as an aggressive rate cut that people are hoping for.
Mm-hmm.
I mean, if you think about it, we went through, a very drastic decline through COVID. Then we went through a very drastic increase post-COVID.
It was crazy.
The idea that the government's going to keep putting us on this roller coaster is unrealistic, right?
Yeah.
So I would say if we do get a cut in June, maybe Q3, maybe a quarter point would probably be a good starting point. So again, I wouldn't be doing things expecting rates to have a dramatic decrease, right?
Good tip.
Now, I will tell you, because people understand that there is going to be a cut, and because we do have a massive housing shortage in Canada, like, that's a fact. We are well undersupplied, and we were undersupplied before, the immigration coming in. We are even more undersupplied today. Builders are holding back inventory. So people are realizing that, hey, when rates come down, prices go up. So now, theoretically, you'd rather buy at a little bit cheaper price today and a slightly higher interest rate than slightly lower interest rate and a higher price, right?
Yeah.
The math is not to your favor. So I would say that if you're looking to get in the market, now is definitely a good time. And, saving a quarter or half basis point on a mortgage is not the reason to wait to buy something, in my opinion. So I do think we have a very healthy market. And I think it's going to be stable for quite a while because, again, just, a standard supply demand problem.
Yeah. The macroeconomics are absolutely crazy. Yeah.
And people want to live, want a place to live, and they want to own, right? I mean, 73% of Canadians say they want to own a home. So of new Canadians. So there's no doubt that the demand will continue for quite a long time.
Amazing. Awesome. I know you guys are one of our partners now with Single, so amazing. Glad to have you on board. If people are listening to you on the podcast and they want to find out more about you, besides coming through Single Key, what's the best way to get a hold of you, Gary?
Yeah, real simple. Website is the number 8 the word 12, and the ending is .mortgage. So 812.mortgage. The .mortgage replaces the .com or the .ca. We were probably the first mortgage company in the world to adopt that right from day one.
Cool.
Hit our website. A lot of great information out there. A lot of things that can help you. And click the link. Submit your information. One of our 25, 30 senior mortgage strategists that are in house will reach out to you and obviously have a very healthy discussion with you on how we can put you in a better situation.
Amazing. Well, thank you very much for your time, Gary.
Likewise.
Lots of great information. Appreciate it.
Appreciate it. Yeah. Thanks for the opportunity, Mackenzie.